Our next speaker will be Graham Matthews from China. He's presenting PricewaterhouseCoopers, and he's going to tell us about investments and the strategies how to do the market penetration into the Chinese market. The floor is yours.
Thank you. Thank you. Good morning, everybody, Your Excellency. I should mention, I should especially thank you for mentioning one of our research reports in your speech. Just in case anybody is interested, we did a 6-month research project in China, working in an open forum with over 100 partner companies, people like large companies like GE, Siemens, small companies, basically studying the whole clean tech, green tech space. That report is available for free. It's a open source collaboration, so it's available for free. I think you can go to our website, pwc.com or pwc.com.cn is the China website, and you'll find a summary there. Or else there is a separate website called China Green Tech Initiative, and you can find more details there too. So quickly mention this. Very quick introduction to myself. I'm a partner in the Shanghai office in PwC. I was first in China 22 years ago as a young student at Fudan University. Last week I was just interviewing the fresh graduates who I was surprised to find that they were born in 1988, so that makes me feel old, as I was at Fudan in 1987. I went back in 95 just to give you some feeling for the growth opportunity in China. In 95 we had about 120 people in the office, and we now have 12,500 people in China. So the growth has been pretty spectacular and actually quite difficult to manage. I work mainly in strategy, but often towards M&A, because my own background is I took 3-4 years out from PwC and worked for Unilever China. I was the business development manager at Unilever. So I was doing the deals, finding deals, negotiating the deals, and about $600 million passed through my hands in those 3 years that I was in that position. Since then, back in PwC, I've worked on about, I'd say, roughly speaking, about 200 projects, deals in the last 8-9 years in China. Actually, one of my first clients was Nokia Malfa 13-14 years ago, but I believe they separated some time ago now. Okay, so a quick overview of what I'm going to talk to you about. I think this must be a theme of this conference, that the Chinese companies are evolving very, very quickly, that the market in China is becoming much more mature, and it's actually harder for a SME company to enter and grow into the market now, because there's less space, and Chinese companies are getting much better at filling that space very quickly. So M&A is also very important as an entry point. We'll touch on doing deals in China. But it's also very challenging because many industries are still protected. You still have to make a joint venture or minority. And the critical problem is valuation. It's always very difficult to agree a value for a company in China. Chinese companies are coming out looking to buy, and we'll talk about why they're doing that. But I guess the overall theme is that in any case, you need to have a strategy for China. You can't kind of sit here and hope that either you can kind of somehow benefit from China by being passive. You have to have an active strategy to capture the opportunity. Okay, so I guess just to look back on a little historical context. I guess since about 1980, 1979, 1980, this is when China's reformed its economy. And I think at first, during the 1980s, this is when we first see some foreign investment. The first WOFI, the first JVs of 1983, 84. And during the 1980s, the emphasis is always on reform, trying to reform the state-owned companies. But at the same time, you have a kind of a private sector, but it wasn't called private sector, it was called the collective sector, which is this C part here. The collectives are basically small entrepreneurial companies, often in small towns near the countryside, in light industries. And then during the 1990s, we see much more foreign capital coming in. We actually see some purely private company. This is the P. And the collectives also growing very quickly. And some of the SOEs during this period are shut down, some of the ones that cannot be reformed. And others become partially listed. And then some people at that time, they mistook this for a kind of privatization wave similar to what we saw in Russia. But actually, China always very careful about privatization, and I think had the benefit of seeing what happened in Russia, and so decided that that wouldn't be the way China went. And so the policy, the Zhurongji, at the time they called it, grasp the big, release the small. This is just a very short number of words that conveys a lot of meaning. And what this basically means is that the small SOEs, they were allowed to go. They were allowed to be privatized, and they're not strategic industries. But the large SOEs in the strategic industries, these were to become these were to be reformed, restructured, but not privatized. They were to have diversity of capital sources, but these were to be the future national champions. So actually, although people like to think that the SOEs are somehow less important, they're not. They're very resilient. And although there was a bit of a decrease last year, the share of the SOEs in the total industrial profit has remained quite constant. And in fact, the role of the SOEs becomes more and more important in China, because the SOEs are the large companies that can be more directly influenced by the government to go out and to actually follow the policies of the central government. I think it's much more difficult for the central government to tell a private company what to do than it is to tell a state-owned company. So in actual fact, the large SOEs are getting larger and more powerful. And the SOEs that you may come into contact with outside, or the Chinese companies you may come into contact outside China, these may often actually be the large state-owned enterprise. So what we have is, these large SOEs are basically being built up into national champion. And if you look at this is the Fortune 500 rankings. If you look at the Fortune 500, if you'd have gone back 10 years ago, you probably wouldn't find any, or one or two Chinese companies in Fortune 500. I myself am very cynical about things like Fortune 500, but in any case, now you find, in the top 100, you find these companies, and what's interesting is there's now about 155 centrally owned large state-owned groups, and in general, what's happened is the industries have been consolidated into these very large groups. So we have Sinopec being the largest. That's the main refiner. State Grid as utility, ICBC banking. So it's quite kind of industry focused. You have one or two very large groups in each industry, and I guess over the last 7, 8, 9, 10 years, a lot of emphasis has gone into consolidation in China. China was so fragmented. When I was working in Unilever doing deals, for example, we look at soy sauce business. There was 2,500 soy sauce companies in China, and you think, how can you ever make money in this kind of business? It's so fragmented. There's so much competition. So for China itself, this is a big problem. The one reason for low profitability in general was fragmentation. I mean, if you go back to this chart here, what's quite interesting is the profit as a percent of GDP. The actual profit was very, very low. If you go back 13 years ago, 2% of GDP, and you can bet that 2% was inflated as well by some creative accounting. So it was already very, very low, and this trend of increasing profitability up to this 10% level, I think a large cause of this is consolidation, is the government pushing through consolidation in different industries. So the final result is we have a lot more large, powerful companies. And if you don't know the logos of some of these companies now, I think you will do pretty soon, or in the next 5 to 15 years. And the logos of keep pressing the wrong button. The logos of these companies will become as familiar to you as Nokia or BP or any of the other big companies. So, and what that means, though, is that having much stronger companies, domestic companies, means that it's actually it becomes more competitive and a little bit more difficult for foreign companies in China, because many of the gaps in the market are being closed. And as the previous speaker mentioned, and as the ambassador mentioned before, China is still a partially planned economy. Currently it's the 11th 5-year plan, and the theme is independent innovation. Okay, so not just innovation, it's independent innovation. And the previous speaker was talking about the electric car industry, and here's another kind of example of that. For traditional automotive industry, China followed this joint venture approach. The hope was to bring in the VWs, the GMs, Toyota into a joint venture and try to transfer technology and capital from the foreign joint venture partner to the local joint venture partner. But actually, this hasn't been very successful at all. And if you look at the vehicle sales figures, you'll see that the China automobile market is still dominated by GM, VW, the Japanese, and Hyundai. And it's interesting, the Chinese automotive companies that are doing well, like BYD, who was just mentioned, they didn't have joint ventures. They're not actually state-owned companies. They were outside of the planning system. So actually, although a company like, for example, Shanghai Automotive, they've had 20 years to learn from Volkswagen and GM. They've made billions of dollars of profits, but they still don't really have their own business. They don't have they acquired the Rover business in the UK, and they've launched that in China, but it's still very small. They sell maybe 40,000 units per year, whereas they sell 1 million Shanghai GM units per year. So that means that when China looks at this new technology like electric vehicle, this is obviously a great opportunity to develop independent innovation and to actually jump over the traditional internal combustion engine and develop Chinese-controlled technology. So, for example, for electric vehicle, if you're going to manufacture electric vehicle in China, then one of the 3 core components must be sourced from a local firm, either the battery, the motor, or the control unit. The subsidies will be targeted towards the local company. And basically China won't make the same mistake they made with the traditional internal combustion engine. This time, China can be a leader in this field on a global level. So you can see that it's the landscape has shifted. It's not like 5-10 years ago where you could bring some technology into China and hope to keep it separate and hope to make money from it. China's very actively trying to develop its own technology in competition. So when we talk about M&A opportunities for foreign companies in China, I put together this data. This basically breaks down all of the deal volume and value by half. This is a half year, 6 months, 6 months, 6 months, 6 months, 6 months. Then we break this down into strategic buyers, which means corporation, and financial buyers, which means private equity. And then here we have the outbound, which is the Chinese company going out. This data is, frankly, not great quality. We have to spend long time to clean up this information. But there's some kind of interesting trends you can see here. First of all, for corporates, if you look at the total number of deal, it goes up quite quickly, but almost all of that is from domestic company doing more and more deal. 1,100, 1,500, 1,400, 1,600. This year is, of course, the financial crisis. But that's what I said before, that it's the domestic companies who are out consolidating different industries in China. But actually the foreign companies, like you guys in this room, the actual volume of foreign deal doesn't really change very much. So it's just below 300, just over 300, around 300, just below 300. Not really changed very much, and that's because it's quite difficult to do deal in China. Because of these cultural reasons, because of valuation issues. Typically when we're working in projects for clients in China, a typical deal process can be as short as 3 to 6 months. I think 3 months is an absolute record and very unusual. 6 months is possible. But we've also been involved in, I think the average is more like 18 months to 2 years. And if you're trying to manage the deal by flying in from Finland into China, then you can probably stretch this out to 3 or 4 years because you may lose the momentum. Our record is 10 years. We're still helping one client after 10 years to try and to close a deal. And now they actually have to ask. They change their people so often. We're the only people who actually know the history. But so really this what's kind of interesting there. You see that again the domestic. It's the domestic companies who are doing most of the deals. Now, another big trend in the last few years is the financial buyers. These are the private equity funds. So you're now actually competing with these guys as well. And foreign private equity funds, people like the Carlyles, the Warburg Pincuses of this world, they basically they came back into China about 5 years ago. And at that time, there are no domestic private equity funds. Okay, it's like a new industry opening up in China. So the foreign, again, originally the foreign funds were doing quite okay, but if you see the actual level of foreign fund activity started to drop off around here. This is before the financial crisis. Okay, this is not after the financial crisis. And actually, what you're seeing is that the domestic funds, they've sat there, they've watched the foreign funds, they've learned, and they've now built up, there's a very active domestic private equity industry. And the domestic guys are now closing many more deals. The foreign private equity activity basically stopped for most of this year, but the domestic continued to grow. So and if you consider this as an industry, it's the asset management industry. again, it's quite an interesting story, because you see that the foreign firms, they were the first there. They kind of brought some of the techniques. They trained up the people, and then most of these domestic funds are set up by people who are leaving the foreign funds to set up the domestic funds. So there's now a very healthy domestic private equity industry. Now, when we look at the outbound deals, sorry this is so low, I hope you can see it. You can see the outbound kind of increasing, but outbound obviously gets a lot more media attention. The actual number of deals is actually not that high, but because the deals are in sectors that are more strategic, like oil or mining, it gets a lot more media attention. But you're really only talking about 50 to 60 deals. And the total, if you look at the total size of the, $22.8 billion isn't that much. When one large deal in the US is typically $20 billion. So I guess in China, everything is, for a deal to be successful, it's all about timing. The most critical thing is timing, because valuation is driven by timing. If you look at these, if you look at this chart here, this is basically the Shanghai Stock Exchange mapped against the Dow Jones Index from 2005 through to 2009. And what you see here is that the scale is slightly. You have to just think about the scale of this diagram first, because this period here on the Dow Jones, this is a run-up. This is almost a 30-40% increase. That sounds like a lot, but you compare it to that. That's a 300% increase in that period, which is why that looks like it's only a small increase, because this is such a big increase. And what's really been happening here is, the Shanghai Stock Exchange is still very impacted by government policy. Most people in China, for most entrepreneurs, they would much rather do an IPO than sell their company to you. That's the simple fact, and the reason is because in China, when you do an IPO, you can get a price, you can get 30 times earnings. The average IPO PE in China is about 32. In Hong Kong is about 20. But the average multiple many foreign companies are looking to pay might be 8 times EBIT maximum. So if you're a Chinese entrepreneur, you've got a choice between 32 times versus 8. What are you going to choose? So now the only thing in for foreign companies trying to buy Chinese companies, that means you have to pay attention to timing, because this 32 PE is not always available. And that's why this chart is quite important, because, for example, during the period from 2005 to roughly the end of 2006, actually going back to 2003, the Shanghai stock market was dead. Nothing was happening, and that was because during that period, the shares of listed companies, there was about 25% was listed and tradable, and about 70% was not tradable. And this 70% was hanging over the market like a kind of a sword pointing down. So during this period, the market was dead. And then at this time here, the government basically reformed this system. After the reform was complete, the market starts to shoot up, and the money starts flowing back into the market. Now, around about this time here in October, because the stock market was starting to come down, the government basically switched off the IPO and said, okay, no one is allowed to IPO because we must reduce the supply of new companies to the market. Okay, so around about this time, the 32 times PE multiple is gone. Okay, so around about this time, you have a chance to do a deal. But once the market is reopened, and the market reopened a couple of months ago, IPO was kind of reopened. Obviously it gets a lot more difficult to do a deal, because now everyone immediately starts thinking, okay, I can go and get a 32 times PE again. So, doing deals in China is you have to pay a lot of attention to the policy, and you have to pay a lot of attention to valuation. Many of the deals that we work on, the single biggest problem between the two parties is a valuation issue. So as we mentioned, 31 times. Recently in Shenzhen, there was a new NASDAQ-style market opened up, making it much easier for smaller companies to IPO there as well. So that's more deal competition. And of course, the other competition you have now is from private equity. Many of the small domestic company, they now have the option of domestic private equity instead. So just looking at these outbound deals, it's kind of hard to squeeze these onto one diagram actually, but we tried. Yeah, you can see that most of the, many of these deals, the dark blue, the light blue, these are really resources linked deals for oil, for access to minerals, etc. But the white boxes, these are more kind of traditional deal. CIC is the sovereign wealth funds. This is different. This is not really deal. This is just a financial investment. But you can see this as well. You can't really call this a deal. This is a foreign investment flow. But it's kind of interesting if you look at the Geely, Chery, Chiré, Geely, the people who are actually in the auto industry who are going out doing the deals, it's the private companies. It's not the state-owned company. In telecoms, China Mobile, quite active here. But I think at the moment, most of the deals are still, the motivation is still to acquire resources. Or it's to acquire technology. And the reason, though, that many Chinese companies go outside to buy technology, it's not actually to win a foreign market, it's to help them win back in China. Because China is so competitive, and that all Chinese companies face so much competition from other Chinese companies, not from foreign companies, that they have to, first they have to win in China. Then they can think about winning outside China. So actually what we find is we work with many Chinese companies on their overseas deals. We're working with Beijing Auto right now in Sweden. We were working with them previously with Opel in Germany. And the motivations of the companies, the Chinese companies, is to acquire something, bring it back to China, and help them win in China. So, for example, Beijing Auto and Saab. Beijing Auto are not really interested in selling cars in Sweden, right? They're really interested in selling cars in China. And so the Saab, this particular vehicle, it's quite high-end, like Volvo. There's actually a very large demand for this kind of vehicle in China. The whole business case is about how many Saabs can you sell in China, not Beijing. In something more simple like branded sports clothing, all these brands, Sergio Tacchini, Fila, Kappa, these are all the old, if you're my kind of age, you'd have remembered all the tennis stars. 25 years ago, these are the clothes they wore. Bjorn Borg was Fila, right? All of those brands have been bought by Chinese companies. Why? It's not because they want to, launch Fila products in Italy. It's because there's an enormous market in China for those products. In fact, the company that bought the Kappa brand, this company is called Dongxiang. Their business, they built the business in 3 years. They built the business almost to the same size as Adidas in China. So over time, these companies are more interested in global markets. But right now, for most Chinese companies, they're more interested in making sure they win in China than they are in actually developing global markets. So therefore, if Chinese company approaches you and talks to you about buying your company, the key thing you have to think about isn't how much your business is worth, in Finland or in Europe. The key thing you have to think about is, what is this business worth in China, and what does what could your technology or what could this business do to help the Chinese company in China? Well, it's this is a very difficult question. I'm not going to, you can't possibly cover everything here, but for I guess for small and medium-sized companies, I guess what we find is quite often they will get into situations that, or they start talking to partners who aren't the right partners. They often get themselves into, perhaps you meet somebody at a trade show. You may have, it may be a customer, but what we often find is many small, medium companies, they don't actually go through a very good process to think about, how should we enter China? Should we be working with somebody? Should we buy somebody? The most extreme example is we've even had clients in negotiations. We say to them, how did you possibly meet these people? Why are you negotiating with this guy? And they say, well, they sent me an email or they cold called me. And this is how people actually sometimes get into negotiations. So I think the first thing you need is a basic management information system. You have to understand what's happening in the industry that you're interested in. You have to understand something about what your competitors are doing. And you have to be thinking about, who are the active companies, who should we shortlist as targets or partners. And then you have to start to build relationships with these guys. Probably the best way to build relationships is to start, if you can set up some sourcing business, for example, if you can start to place some small orders with some Chinese company. This is actually the best way to get to know them. They'll invite you to the factory, they'll let you have a look around, they'll tell you pretty much everything. So it's to build this kind of relationship. And then also, on these trips to China, you can then start to build up a network of, a China expert kind of network. At the same time, as I mentioned, you have to pay attention to these timing issues. Unless the timing is right, you won't be able to get a deal done. So you have to monitor this kind of IPO cycle. Don't rule out joint ventures. Actually, joint ventures had a very bad reputation. But the reality is that in many industries, you still have to do joint venture. If you're in certain telecoms, internet, for example, you have to do joint venture. There's no other way around it. So don't rule this out. And then also, many Chinese companies now are much stronger. It's not like 10, 15 years ago where the foreign company could kind of go in and basically say, okay, we want this. Now many Chinese companies much stronger. They may not accept what you want, and they have their own opinion, and they're not willing to sell. Okay, they're only willing to work with you as an equal partner. And then don't forget, make a very clear assessment of your own value. And this is what I was talking about. You can't think of your value here. You must understand your value in the context of China. We're working now with going back to this electric vehicle example, we're working now with a battery supplier. Probably the most important piece of technology in an electric vehicle is the battery. And they don't really, they didn't really understand what is their value to the Chinese company. But actually, according to the regulation, for a Chinese company to make an electric vehicle, it must have a local, one of these three components must be from a locally controlled company. So our client, they approach the Chinese company, and the Chinese company say to them, we must have 51%, we must have 51%. But they would never tell them why they needed 51%. Actually, the reason why is because if they don't get 51% in the joint venture, they won't be able to get a license to build electric vehicle. So actually, if you give up 51%, you create a huge amount of value for the Chinese company. But unless you do your research, you won't understand that, and you'll sell yourself at too low a price. So yeah, the last point is to understand the value of your business, but through Chinese eyes. We have a couple of minutes for question and answer. I don't know if that's appropriate in this setting, but if anyone has any question, we'd be pleased to. If not, then we'll see you at the Expo next year. And this is the Finland Pavilion that looks very beautiful and high-tech. So I think that'll be a great opportunity to come next year and to understand more about what China's really about. Okay, thank you.
Thank you. Thank you, Graham, for your presentation. I have to say that we are going in a circle of 5. Mr. Ambassador started with 5 boxes, and you ended this part with 5 bullet points. So I think we have had a very good start with our meeting. Now we're going to have a coffee break, and let's be back from the coffee break around 11 o'clock. Thank you.